So earlier this week, I posted a video about all the investments that I have and how I'm approaching investing and how you should approach investing, especially if you are new to it or if all you've ever focused on is making money or making money online, but you never actually thought about what do I do with the money once I make it. And for all the cash that you have that you don't have something active to invest it into, such as like reinvesting it into a business or developing a higher income skill or anything like that, if you do nothing, that money's just going to sit there and it's going to lose its value over time. So where do you put it? Well, in the last video, I talked about how my main method is to max out retirement accounts, which have really high tax advantages. And I put 95% of it in basically funds that track the S&P 500, which is basically just the top 500 performing companies in the United States. The reason that people want something like the S&P 500 is because it's something that's been able to slowly but steadily go up over time. So when you invest, you can expect around 10% returns every single year. There's some fluctuation year to year. So for example, during a financial crisis like in 2008, the stock could drop all the way to $683, which is significantly lower than it was 2 or 3 years ago. But over time, the stock market will pretty much always recover, and it's a good place to grow your money. But I was like, well, what if there's something like the S&P 500 that has even more volatility, but even more upside? The idea was that if I'm holding on to my money for like 40 years plus, for example, like all the money in my retirement account, I get penalized if I take it out before age 59 and a half. So for all the money that I'm not going to be taking out for a very long time that's in there anyways, is there really no investment that's just riskier or higher volatility, but over time has better returns over the long run? Because I'm going to be able to hold it for a really long time so I can handle more risk. So one thing I looked into is something called a leveraged ETF. This basically can take a normal index fund like the S&P 500 and basically just double the daily returns. So if the S&P 500 goes up 10% in a day, then a 2x leveraged ETF would go up 20% in a day. On the other hand, if the stock market went down 10% in a day, the leveraged ETF would go down 20% that day. So initially, I thought this seems like a good stock that you should invest in, especially if it's something you plan to hold long term. Because again, I'm going to hold the money in my retirement accounts for 40 years anyways. Shouldn't I take something that's a riskier investment but should have better returns over the long run? And you might think that this will definitely have better returns over the long run. This is an example of a 2x leveraged version of the S&P 500 right here. And it does seem like it should, but the problem is it doesn't always, and it depends a lot on the volatility of the market. So let's just look at an example. This is an example of Tesla stock versus a 2x leveraged version of Tesla stock. You can see that while Tesla stock itself went up in this time frame, the 2x leveraged version of Tesla stock went down. How is that possible if the leverage is double? Well, it's because of something called volatility decay. So here's an example of how that actually works. If you have a stock that's at $10 and you have an unleveraged version of that, if it goes down by 30% and then up by 50%, it'll actually recover and end up at $10.50 per share. Because if it goes down by the 30%, it's now at $7, and then up by 50% from here, it gains 3.5. It's back at 10.5. Compare this to a 2x leverage stock. That first drawdown in that first day will go from $10 a share to $4 a share, because instead of losing 30%, it'll lose 60%. Now, the problem is that to recover, it has to recover based on its new price. So now if it raises 50%, but it's already at $4 per share, that 50% recovery now equates to 100%, but 100% of 4 only gets you to 8 total. And now you're lower than where you started. And so then the question is, well, how volatile does the market have to be for it to be worth it over the long run to invest in a leveraged ETF? Because if you think about it, the amount of leverage that you choose to take on is kind of arbitrary. Like for example, for some reason, the default leverage that people take on is 1x leverage, but you also could take on 50% leverage. Like you could only put 50% of the money that you could put into the stock market and just hold the rest. Or you could do like 1.1x leverage. That might be a little bit higher risk and at least a little bit higher return. So what's actually the best approach? Well, I found another interesting article that dove further into the topic, which I think really gives us a much more fleshed out answer to this question. Here, it basically says there's nothing specifically magic about a leverage value of 1x. And it goes on how you can actually approach finding the optimal leverage, which is basically how much leverage should you take on to try to maximize your future returns. And it depends on two things. Number one, the annual return that you get in the stock market, that's around 10% on average. But number two, this factor right here, the daily volatility. And it matters at a power of 2. So if it's double the daily volatility, it makes the optimal optimal leverage number 4 times lower. So interestingly, when you actually look at the US stock market and you plug in the average daily volatility and the average yearly returns, it ends up showing that the daily optimal leverage is basically around 2. So does that settle it? Does that mean 2x leverage is the best thing that you should do? Well, still not necessarily, because now you're taking a bet that the stock market is going to be as volatile as it was in the past, which when most people are aiming to be passive investors, they're not aiming to do it based on what they perceive the market volatility to be. They're doing it based on where they perceive the annual return should be. And if you compare from the very start of this 2x leveraged S&P 500 index versus just the normal S&P 500, and you invested 10K at the beginning in both, the S&P 500 would actually beat it because of the instances of volatility decay. However, interestingly enough, they also included what would happen if you put in 10K at the very beginning, but you had a $100 monthly investment throughout the entire time. This seemed to basically smooth out some of the daily volatility and allowed you to invest when the 2x leveraged index fund was lower. And in this instance, you'd actually end up with way more money by the end. So this gives a lot more knowledge on the topic, but it doesn't actually fully answer the question what you should do. For now, my plan is still going to be to just take on 1x leveraged with 95% of my index funds and use the 5% dedicated budget that I have for speculative investments to not only invest in things like crypto or Bitcoin, but also to have something like a 2x or a 3x leveraged ETF to be able to buy if I think we're in the middle of a recession and it wouldn't go down much further or something along those lines. So yeah, I know this video like nobody actually asked for, and I guess initially my channel was entirely known for YouTube automation, but that's kind of the thing on YouTube. If you want to change what you want to talk about, sometimes not all of your audience is going to want to watch that new thing. I want to talk about investing because I think it's a growingly important thing in my life as I've been starting to earn more money. And hopefully after you start to earn more money, it will be something that's more important in your life as well. So I hope this video gave you genuinely good information. And as always, if you want to join our community, we now have, 22,500 members. You guys are insane. The link to the Discord will be in the description. And as always, thank you guys all so much for watching the video. I'll catch you on the next one, and peace.